Well, good afternoon, everyone, and welcome for what is our first quarter in 2020 advisor webinar. Firstly, I hope everyone had a fantastic festive season, and on behalf of the Morningstar team, I wish you all a very, very happy and successful 2020. For those that I haven't yet met, my name is James Lowe, and I lead the team at Morningstar Investment Management that serves advisors across Australia. It's been an exciting one for the Morningstar team for a number of reasons, and one of which you'll be getting to hear in the upcoming events in end of February and March. But also a very exciting one the last sort of month or two, as a lot of you will know, we have a long track record of managing assets on behalf of the advisors we serve and institutions, and these are the assets entrusted to us, which we hold very sort of dear in terms of what we do. Now, while we've been doing that for more than 30 years, the contrarian valuation-driven approach, which many of you as advisors, as like-minded advisors, apply in your practice, is one which we've applied in our real return goals-based funds, which reached their 10-year anniversary over the last sort of couple of months. So with that in mind, what we thought we'd do today was really to reflect on the last 10 years of what it's meant to follow this contrarian valuation-driven approach that you as advisors have done, and so have we. And then also look ahead at probably what lies ahead in terms of the client portfolios which you've entrusted to us and manage on your behalf. And then look at and answer a number of questions which you might have. So with me today is Matt Wacher, our Chief Investment Officer in Asia Pacific, and Matt has personally had one of his milestones. He's just gone through his 1-year anniversary as Chief Investment Officer, so well done, Matthew. We've got a number of questions that we'll be able to you'll be able to ask. I've got a few of my own to share with Matt. But before that, as advisors, you would know we've always got to just ensure that the general advice disclaimer is something that doesn't account for your personal objectives and needs, and it's in general in nature. So Matt, one of the things which all our advisors will be aware of is that protecting investors' capital is really, really important. Why is it more important than actually chasing sort of returns in up markets? Why is it important to preserve that capital?
Thanks, James. Yeah, it's great to have been here for 1 year, I really thought, yeah, this is the place to start. Given that we've invested for 10 years, preserving capital is really important to all of our end investors. Basically, if we preserve capital, what this chart is showing you, if we protect on the downside, if we lose less, we don't need to make as much on the upside. Every drawdown or loss of capital that we have means that we have to make more on the upside. So really what this is telling us is that we don't need to take as much risk on the upside if we protect capital on the downside. Now, portfolios are designed to capture less of the downside. We really like to focus on investing in the best risk-adjusted opportunities that we see in the market and making sure that we don't put our investors' capital at risk.
With that in mind, one of the things I often hear from advisors, if while balancing this downside risk, how do you go about actually achieving what is a real return CPR plus objective while still sort of balancing the risk?
Sure. So, excuse me, really do that by focusing on the areas that we think the best risk-adjusted returns are going to emanate from, and then building portfolios holistically around those positions. We often think in terms of vintages. So over the last 10 years, I could rattle off a number of opportunities that we've invested into. For example, at one stage, I believe the team had 20% invested in the REITs sector alone. We've invested in global credit, European opportunities, these sorts of things. At the same time, building a holistic portfolio around those opportunities. And again, gradually those opportunities will evolve. We'll do deeper research into each. It may start as a valuation opportunity. I'll talk through a couple of those in a moment. And eventually, we may even get quite specific into those opportunities where we think we can really generate some great risk-adjusted returns. So an example of that would be, our Korean shares position at the moment, which we'd call a young kind of vintage, has really emanated from a maturing vintage, such as our own emerging markets position we had over the longer some of the more mature positions that we've had in our portfolio, US Treasuries and emerging market bonds, the ones that we're starting to downweight and exit at the moment. And that's how we like to think about investing in our portfolio.
So while being contrarian, they, again, a couple of questions I often get, because we apply conviction in what we do, and the questions we get are they set and forget type positions, or how do you manage that?
So perhaps it would be good to talk through a couple of those positions that we've held over the last 10 years. A good one that we're still invested in at the moment is the UK and UK equities in particular. Really, this position, to take your point, James, it started as a valuation opportunity. We saw an opportunity to invest straight the day after Brexit the vote occurred. We invested in UK equities, including UK banks. That played out very quickly for us as the market saw that actually it wasn't all doom and gloom. And we really did well out of that position early on. But as the position evolved, what we did was start to look at, well, what's a better way to access this exposure? We looked at the pound, directly investing in the currency there. We've also looked at UK banks and UK energy over time. So the position evolves as we do more work. We've also gained conviction in that position. If you look at the right-hand chart there, as it's become more, what we would say, more a contrarian position. As investors have sort of exited the UK equity market, we've actually gained more confidence that this is the right position to be involved in. And this has paid off very handsomely for us over the years. Recently, as the pound traded up, we were exiting that position as that matured as well. So the positions evolve throughout the time that we hold them and can get quite specific.
I know Japan is somewhere where investors have actually avoided over a long period of time, but it's one where we as a team have had sort of a position there. How's that? I mean, what's attracted the team to Japan over the last 10 years?
Yeah, again, this started as a valuation opportunity, although it didn't turn around days after we invested in it. It was much more 6 to 12 months after we invested in it that our Japan position started to work for us. Really, we invested very soon after the earthquake. We saw back in 2011, we saw a very good opportunity from a valuation perspective. We thought that there was too much pessimism in the pricing of the market there. And so we went and we invested reasonably heavily into Japan. That position has played out over time. As you say, lots of investors see lots of Japanese equities treading water over the years. So once we started to dig deeper into the Japanese position, it's a great valuation opportunity. We saw lots of contrarian behaviour around that. We've actually seen this position play out over time. We've really got very specific, most recently in Japanese financial sector, and are holding reasonable weights in our portfolio to that. And that's because what we've seen is a real shift in corporate governance. We've seen investors. We've seen companies, sorry, not investors, companies really investing the cash on their balance sheet. We've seen them engaging in buybacks and really ramping up their corporate governance structures. So what we're getting from our Japanese position, which was once a pure valuation opportunity, is a whole range of different risk and return drivers to your standard market, other markets out there that we might get much more cyclicality or different drivers. So it's a good position to hold from a holistic portfolio perspective.
And I know on the other side of the coin, and again, this is one I know the team gets a lot from advisors, is there's certain areas in the US and Australia where you haven't invested, and we didn't believe it was appropriate to invest on the capital that we manage on behalf of advisors. What's your view on that?
So yes, the US and Australia, we have invested in the US and Australia. We probably haven't invested to the extent of some of the other positions that we have invested in. And that's really come down to where we see the markets as really at extremes at the moment. We have done for the last sort of 18 months or so. And what you see on the charts here is that world markets have really lagged the US. This is what we're seeing is a very extreme position at the moment. And on the right, US value stocks, which is where we would see opportunities, have really lagged US growth stocks, those tech stocks and whatnot. US value stocks have really lagged those areas. And we think that this is really at an extreme now. We have been saying this for a while, but we think that allocating capital to these areas, significant amounts of capital, really is actually just putting client money at And so we've sought to look for other areas where we think that there's better opportunities, the Japans and the UK's emerging markets, and that's what we've done. We think that, generally what we'd like to do, to steal a Warren Buffett quote, is be greedy when others are fearful and fearful when others are greedy. And I think that the examples that I've given show both sides of the fence there.
That's a great reflection and sort of summary of the last 10 years. So probably looking ahead, and we all know that in this rally, in this bull market that's been taking place, what does this mean for expected, and will it continue? And then secondly, what does that mean for expected sort of valuation implied returns over the next 10 years?
So what we'll see, what I expect over the next 10 years is that this rally won't continue. It'll end at some stage. I think that we really do need to reset our expectations. I don't think we're going to relive the 2010s in terms of returns. Again, it's been a very fruitful period for investors, very high returns over the period. But what we see on the chart here is really that this is, as I'm sure everyone's well aware, this has been one of the longest, the longest rally in US equities for forever. And generally, what we see is that it doesn't go on forever, and there's some level of a crash or drawdown at some stage. I think that I don't know when that's going to come. I think that we just need to consistently think about protecting capital for our investors, and over the next 10 years, I'm sure that we will see a drawdown in US equities, lower expected returns. I think that the rally has really been focused over the last year in particular on liquidity in the market provided by the Fed, especially in the last quarter when we saw not QE4, and also interest rates being very low. At the same time, I think other markets haven't participated as fruitfully in this rally, and generally they're being priced for lower growth expectations.
So how's this market really then been supported, and what is the outlook for earnings, which is absolutely critical as we obviously look ahead?
Sure. What you see on this chart, the blue bars are where we see multiple expansion, PE expansion. The green bars are earnings. And what you see over the last 8 years, there's been a couple of pockets of earnings growth, but really that was driven back in 2017 from US tax cuts. And generally speaking, multiple expansion has been the order of the day over the last few years. That's been driven by a number of factors, lower for longer interest rates, etc. That's really driven the US rally. People are banking on interest rates to remain low, and that's driven multiples higher. They think that those multiples can be sustained. What we really do need to see is earnings growth come back. I think that even expectations for this year, 2020, are that earnings aren't going to deliver necessarily a huge uplift to markets. It's really, they want to make sure that interest rates stay low. Whereas other areas, this is a chart on global markets, other areas such as the UK, Japan, emerging markets and Europe, they haven't had earnings either, but they've really been priced for recession. And so that's one of the reasons why we think that there's a better opportunity in areas outside of the US and to some extent Australia as well.
You briefly mentioned interest rates a little earlier. And what effect has interest rates really had on markets?
Well, interest rates have really funded that multiple expansion that we saw on the last chart from an equity perspective. It's also meant that the bond market is extremely expensive at this. Global bond markets are extremely expensive. We see negative interest rates in so many areas, and that means that it's very difficult to, where we started out talking about protecting capital and downside protection. It's very difficult to enter the bond market in order to protect and build holistic portfolios and protect our clients' capital. So one of the things that we have done a lot over the last 2 years to 18 months is hold a lot more cash than we generally would. Generally speaking, we wouldn't want to hold a low yielding asset like cash. We'd always hold some cash for opportunistic plays, but in terms of trying to build a holistic portfolio, we think that there's potential for significant losses, especially at the long end of the curve, at the yield curve, if there's any sign of inflation coming back or bond yields reverting. And that will also affect equity markets, we believe, if there is any. I think they're very sensitive to moves in interest rates at the moment, or any sign of an upward trend in interest rates.
So in terms of areas of high conviction, or where we have conviction in positions, and on the screen, there's a lot of red there at the moment. So logic would say sort of very few opportunities, but it might be worthwhile you sort of going into a bit of detail on that for the advisors.
Sure. So we've talked about the US and Australia. I think what we're seeing here is that, as I said, it's very difficult to build a robust portfolio when there's so few opportunities out there. I think we are holding more cash than we generally would in order to be opportunistic. We're getting much more granular on the opportunities that we do hold. I spoke about Japanese financials, for example, or holding specifically Germany and South Korea as opposed to Europe and emerging markets. Even getting much more granular in the opportunities that in sectors and whatnot as well. So currently doing a lot of work on European energy, for example. What that does is allows us to still build a diversified portfolio. There's still risk involved in those positions that we're holding. So we need to balance that by the cash weightings that we have, because there's quite a lot of cyclicality coming into some of those positions that we're holding. They could fall if we do get a shock in the markets, but we're betting that over 10 years, they're going to deliver much better returns than the positions there that you see in red that we don't really have conviction in at this stage. That could change over the course of 10 years. If we do get that earnings growth that we were discussing, if there is a market sell-off or if interest rates change, we would expect that over the 10 years that our overall conviction in many of the positions you see here will fluctuate. And we want to be ready to invest in those opportunities. And we need to deliver on objectives over the next 10 years.
And for the advisors who follow a sort of contrarian valuation approach, and I think I heard you say that these opportunities are quite cyclical. I mean, things can change in that regard. So they are quite cyclical, the opportunities?
At the moment, yeah. So some of the opportunities that we are holding, the Germanys, the South Koreas, Japan, there is a lot of cyclicality in some of those names. So we would expect them in a recession type scenario to sell off. Yes. We're not saying that they won't, that they're protecting everyone, but we think there's enough of a margin of safety in there to deliver value over the long term.
And as you said, cash playing a key role. Yeah. I thought I'd just pause at this point, and we've had a couple of questions come in. I thought before we move on to the third aspect of the presentation, which is really about why we invest in the way we do to sort of help the clients of advisors achieve their goals. We've had one question coming in, and I'll read it out. I'm seeing more international retirement funds entering the Australian market and bulk buying Australian property to hold as an income play. Rental returns in the range of 5 to 6%. Any comments in relation to your thoughts on Australian REITs?
So yeah, at the moment we see Australian REITs as expensive. It doesn't mean that we would never hold Australian REITs. As I mentioned back in the early 2010s, I think 20% of the portfolio is in Australian REITs. But at this point in time, and potentially because of what the question has described, because there's been a lot of demand, it's pushed up valuations. And we think that while there's a good income yield attached to that, you certainly have to pay up for that income yield at this point in time. And so it's an area that we are holding REITs in all of our portfolios, but we're not fully invested there, as I'd say, at this point in time.
Great answer. And knowing the advisor sent that through, I know he's an advisor who's recently partnered with us. We'll be happy outside of this also going to a bit of a history of the various vintages in Australian REITs with you. So how should we think about the results for investors over the last 10 years on reflection?
On reflection, I think that we've delivered certainly on investor objectives, and I'd like to, the chart on the screen here shows that relative to the peer group that our friends at Morningstar monitor, that we've outperformed over rolling 5-year returns. I think if we were to show this chart as a rolling 3-year or obviously 1 year, we'd potentially be underperforming. So the way that I think that people need to think about what we've delivered is that, you know, we're going to be we're going to be a tortoise as opposed to a hare. In strong upward markets, we believe that we won't outperform our peers. We're really focused on, as I said, that risk-adjusted returns, that focus on downside protection. Certainly, we will do much better than our peers we would expect in a down market. So if we look at the risk-adjusted returns, you can see that from a risk-adjusted or a Sharpe ratio perspective, which is a measure of risk-adjusted returns, we're well in excess of our peers and the wider peer group. And that's what we'd aim to deliver. That we think that that's a good result, especially when we're delivering, you know, on the objectives, significantly outperforming the objectives of the fund.
I mean, we spoke about capital preservation and significant drawdown. How's that, and the impacts of drawdown? How's that gone? And the evidence of that in the portfolios that we manage on behalf of the advisors?
Yeah, so I think that's a really good point, James. We talk a lot about, you know, downside protection, but how has it actually worked? And this chart shows over the whole 10 years that we've been managing portfolios that in almost in every case where there's been a significant drawdown, we've been able to protect capital and probably draw down, I think, some of our calculations in most cases by only 50% of what the market had actually drawn down at any particular point in time. And as I've mentioned earlier, that really means that we can take a lot less risk on the upside and still deliver on the objectives of our clients and help them to meet their goals over the longer term. And I think the proof's in the pudding there in terms of this chart.
We've had another question come in, which a really good one, I think, is given that the market has more up days than down, and the up day returns outweigh the downside negative returns, do you still think that the valuation style approach to investing is optimal by itself?
Yeah, that is a really good question. I think that yes, is the short answer, and then you'd expect me to say
another year at Morningstar,
That's right, yeah. But I think that really what we want to do is make sure that we're capturing enough of the upside. We don't want to invest. We certainly don't want to be lagging too much on the upside, but we don't want to be taking unwarranted risks in portfolios. That if we then capture, in this case on this chart, 50% or just slightly above 50% of the downside, it means that over the longer term, even though there are much fewer down days in markets, often markets will sell off a lot quicker and a lot more savagely than they'll grind upwards. And we've seen that, even the examples that we see on the screen show that. But what we really want to do is focus on the longer term. And when we make sure that we only capture a smaller part of the downside, coupled with capturing a significant portion, 75% or to 90% of the upside, and making sure that we do that in a really risk-focused way, then we are confident that we will outperform over the longer term. And we'll certainly deliver on the objectives of our clients.
And the questions are coming through thick and fast here, which is fantastic. Linked to that, so what is your goal for upside capture in the long term?
So we don't have a goal for upside capture. We don't have a goal for downside capture either. It's more an outcome of our process. What we do have drawdown limits in our portfolios, and we monitor drawdowns. The upside downside capture is really an outcome of the process that we employ. And anyway, what we would focus on is that sometimes the upside capture, if we're investing in highly cyclical names and we get a spurt of growth, we would expect that the upside capture may potentially be higher. The beta of our portfolio may actually be slightly higher than it would in other times. It'll be variable throughout over a 10-year period. It's going to vary, but we'd like to see around 80-50, 80-60 kind of upside downside capture in order to deliver significant outperformance over time, and certainly better risk adjusted returns over the long term.
And for the advisors that actually have come through with those similar sort of questions, I'll take as an action on my side. I'll also share with you, Jodie Fitzgerald in the previous quarter's webinar went through about the whole concept of downside capture and upside capture and how the process works. I think it'd be super valuable for us to share that with you, and I'll get one of the team serving advisors to also discuss it with you. We've had another question, just to revert back to the question about Australian super funds, and the comment was about buying physical property. So sort of direct property, and I know we've done a lot of work recently on this, which we can hopefully be sharing with advisors soon.
Sure, I think that, but effectively you're trying to, what the question's asking is, can you capture an illiquidity premium? I think that certainly holding illiquid assets looks good from a volatility perspective. The assets aren't as regularly valued. What we see though is that over the longer term, that the valuation mismatch there tends to wash out, and that REITs, listed REITs, and unlisted property tend to, the returns tend to match up over the longer term. But what we do see is, because of the valuation lag, as it were, that it has the appearance of better risk-adjusted returns in some of those unlisted assets. At the same time, it doesn't give you the ability to reposition the portfolio very quickly and adeptly as we've done over the last 10 years, because your liquidity is locked up.
Last question that we'll sort of cover before we wrap up, to make sure that getting to the top of the half hour. Over the last 10 years, obviously we've been talking about from a multi-asset perspective, and the questions come through more about valuation investment approach as at an Australian equity sort of growth level. How's the performance of that sector as a whole, in particular with the approach that Morningstar follows in managing those sort of solutions?
So we have a direct equity strategy that is valuation based. That strategy has performed very well. I think outperformed the market last year. I can't think of the exact returns, but if the market was up 22%, I think that the strategy was up about 24%. A lot of that return came in the second half of the year, as people started to look a little bit more at valuations, although not, there's still a big momentum trade going on. Over the 10 years, that strategy, it hasn't been going for 10 years, but it's performed very well. We hold that strategy in our portfolios because we think it gives you a good diverse opportunity set, and it adds a lot of value to the portfolios that we manage.
Well, thank you, Matt. Really appreciate your time and going through this. I thought it was really apt that having the 1 year anniversary, that you could talk through the 10-year history of the funds. But I know that we'll be on the road visiting advisors at the end of February, and many of the advisors will get to discuss with you then. In terms of some of the questions that we haven't been able to get to, what we will be doing is making sure that we do get back to you, and a member of the team and a portfolio specialist, being Clint Abraham, potentially could also be a part of those conversations with you to ensure you have the information that you need to engage with your clients on a regular basis. So just to wrap up, two sort of closing comments. All of you would have received an invitation to our upcoming events at the end of February. Thank you for those that have registered. We are well ahead of where we were this time last year, so really great that you found those a lot of value. For those that haven't registered, I would encourage you to do it as soon as you possibly can. I would hate to have anyone who can't attend you do sort of numbers capping out there, but we're really looking forward to speaking to you and actually having some of those face-to-face discussions. With that, thank you once again. You will be getting a follow-up to today's webinar, and it will be the standard way in which we serve you, which is ensuring that you get a couple of slides with scripts that you can then share with your clients. Should you want to do your own videos or your own conversations with that, there will also be a short video, which Matt has kindly completed, which we will share with you if you wanted to send it on to your clients also. In addition to that, there will be obviously a recording and the full slides of today to support you in those conversations. So have a fantastic day, and thank you for your time once again. We're really privileged by you giving us your time, and we'll see you again at the end of February. Thank you.